Ajay, let's get our conversation started. Last 2 years, let's first talk about your experience from managing really a different industry, a different parameter. Now you are heading the entire financial service and the financial service business for the Birla Group.
Yeah, it's been 2 years since I moved back from Hong Kong. I was running fund management across Asia in very different markets, 10 markets across Asia, running about $70 billion. From that, I think there have been basically 2 or 3 changes since I moved back. One, a change to a single market, so really operating in India today. Second, operating across a multiple number of financial services verticals. So today we cover 7 legal entities covering pretty much most of the non-banking space in financial services. And the third, I think, a call to make the move to an Indian house, which opens many doors in this country.
So in hindsight, if you look back, was the call largely oriented that India's economy will grow and financial services is a proxy to Indian growth?
Yeah, I think the call is really been taken on what I see as the potential of the Indian financial services sector. And in my view, I think there are many structural benefits that India will enjoy for many years to come in the financial services space. And if I were to just enumerate some of them, clearly the size of the population is one. When you're looking at retail services, retail financial services, the size of the population is one. I think it's very clearly today evident to many people that India will be one of the fastest growing economies in the world for some years to come, but it's the second fastest growing economy in the world for some years to come. And I think GDP growth has its own momentum, therefore, in terms of what it does for financial savings. If you add to that the fact that Indians save a reasonable amount, the savings culture is very strong in India, and that penetration of financial services is still just so low in India. After 40 years of the mutual fund industry being around 4 or 5% of household savings goes into mutual funds. The number in life insurance over a slightly longer period would be 10, 12, 14%. So with that kind of penetration levels and the kind of growth and the amount of savings we're going to see, I think you're going to see many, many years of significant growth in the financial services sector.
3% of your total population is invested in equities. And that really has been the thesis, but that doesn't mean that money is coming back on a yearly basis to equity markets.
True, but I think that behavior and that number is changing slowly. I would say it is definitely changing to a more equity culture. I think in terms of mutual funds, we've seen a slow increase in the penetration of equity mutual funds, for instance. If you take the number of demat accounts that are open today, we cover 1,000 towns in India in terms of the where demat accounts are open. And I think if you start looking at the number of incremental, the number of people participating in the market, I think it is definitely moving. I think that's going to only continue to change because of a couple of things. I think one, with the demographics of the country as they are today, you have a much younger population in India. Many more people now in the working group. I think that definitely triggers off a greater increase in interest in equity. And the second, I think, is if you look at the alternate investment options that are available, I think definitely over a period of time, people are starting to realize that equity is a much better performing asset than other assets. And therefore, I think you'll start seeing that move clearly but surely.
Let me divide the various verticals and 7 sub and main verticals for your business. Give us a sense, and every vertical I'm sure has got a different flavor, a different growth track. Yeah. For next 12 to 18 months, where do you see maximum opportunity?
See, I think our verticals are actually divided, although they're 7 legal entities. They're really structured in a way to be able to deal with different consumer needs. And because I'm generally quite bullish and optimistic about financial services in general, I would say that there is really a growth opportunity across this piece, and I'll explain to you why I say that. So if you take life insurance, that's one of our largest verticals, reasonable amount of money invested in that business. We see Indians are, although you may look at penetration levels, people look at premium to GDP. I think if you look at protection typically to per capita income, I would say that number is actually quite low. And therefore I see continued growth in the need for protection and the need for converting savings to investment, which the life insurance company is very well positioned to do. And therefore I see that continuing for some years to come. On the mutual fund side, I think that plays very much to the theme of wealth creation and the growth of wealth in India. And I think we're in a cycle today where you're going to continue to see that improving, partly because of the demographics, partly because of the structural benefits we discussed earlier. So I think the asset management company really plays to this growth in wealth in the country. And therefore, again, I see that continuing to grow over a period of time. We have a private equity business which really caters both to onshore and offshore investors. Again, I think that caters to the higher end of the market, the more sophisticated investor, probably the higher net worth investor, who's again looking for alternate assets to invest in, and private equity is a great asset for for them to look at. Then we have a piece which is really around financial distribution. So we have a distribution business and a retail broking business, both of whom are really taking a customer view of the world and saying, how can I provide a range of customers, not just the Aditya Birla range of products, but an open range, open architecture range of products that the customer can then meet their various requirements. And I think, as I said earlier, if you going to start seeing people moving money from banks to other financial services products, this is going to become a very, very critical piece in that overall scheme of things. And then we have an NBFC, which really all the other businesses typically take money from customers. The NBFC has the ability to provide some financing to customers, and therefore fits in very well strategically with the other businesses we have. And our last business is a general insurance broking business. We are not in manufacturing of general insurance. We couldn't see the attraction of that from our perspective. So we're in the general insurance broking space because that allows us to still offer the service to our customer group without necessarily manufacturing it. So broadly, I would say, I think because they're so different in terms of the niche, in terms of the products and services they provide, and because our customer group is so diverse, I think there is opportunity for growth across all the spectrum.
So, just to understand, essentially you're flagging off is that minus the banking license, you're offering pretty much all the services.
Yeah, we look at ourselves as a fairly significant material non-bank player because we really have the ability to provide most products and services today other than a banking account.
Now let's understand the way the industry is structured. It's important to be a market leader.
See, I think like you rightly say, growth in the insurance business takes up cash, and the reason for that is the first year acquisition costs of the insurance business are typically written off to your P&L. So you get a big P&L hit to your business in the first year if you're adding a significant amount of new business. But I think you have to look at this in the context of the larger opportunity, because if you believe that these are young early days in the stage of the growth of the Indian insurance industry, the private sector has been around 8 years, 9 years. These are long-term businesses built over a period of time. And I think building scale and getting to a position where you really have a reasonably dominant position in the market is very critical for you to be able to build the future economics of the business.
But are you growing at a price? Because if I look at the last 12 months, there is a significant market share gain in insurance and AMC.
So for instance, yesterday we announced our embedded value and the value of new business for our life insurance business, which gives you a sense of the long-term value we are creating in the life insurance business. And I think both are reasonably attractive numbers. Our embedded value is over 3,000 crores. For 2,000 crores of capital invested, an embedded value of 3,000 crores basically means your existing capital itself has got a reasonable return on its investment, and the value of new business as a percentage of our model premium is over 20%. So I would say we are in a position today in this country, in this market, where you can still get a reasonable amount of top line growth and manage a profitable growth.
Do you think Indian market is now mature enough that it's high time we should have independent listed insurance players, independent listed AMCs? Unfortunately, we pretty much have sum of part stories available, whether it's ICICI Bank or whether it's the Birla Group.
Sure, I think that's a question of time. I think you will start seeing that over a period of time. And if I just give you context, I think out of the top 10 most valuable companies in the world, 3 of them are listed Chinese entities. My guess is over the next 3 to 5 years, you're probably likely to see a couple of Indian companies in that list if Indian companies do go public.
Is that a long-term plan even you have for your businesses, the insurance and the AMC business?
See, at the moment our business plans are very well funded by our shareholders, so there's no immediate need for cash as such to have to look to alternate sources of funding. But you never know how these things work out.
On a net basis, including all your businesses, for the financial service arm per se, what's your sense? When do you think you will get your first break even?
I think the break even for the businesses as a whole is really driven by the insurance business, because the other businesses are reasonably profitable and I think will continue to grow in profitability terms. The life insurance business, as I said, is really a business where you have to take this call between the size of your existing book, which then throws off cash because it's an existing book, and the strain of the new business that you write, which is really the cause. So as your existing business grows and grows to a size which is significant compared to the new business, you start seeing profitability. Now my guess is we will continue to see reasonable growth over the next 2 to 3 years. So really then it's a point of where that crossover will happen between when the book becomes large enough to throw off cash bigger than the strain of the new business. But my guess is in the next 2 to 3 years we should get to that point.
If you really understand the Indian customer, is the cost of acquiring Indian customer, AMC business, NBFC business or insurance business, is that getting more expensive now?
I don't think it's getting more expensive, but that is clearly a large part of the total cost that a business like ours would incur, which is one of the reasons why we have these 7 businesses. Because from our perspective, if I get a customer for one business, it's great if I have the ability to sell them other products over their lifetime, because then I don't have to spend the cost of acquiring that customer again. So I would go back then to the vision that I talked about earlier, which is about being a broad-based company. Because if we are broad-based in our offerings, then we have the chance to reduce our cost of acquisition.
We're speaking in November 2009. Let's try and understand the big picture. And I'm just going to give the sketch, you fill in the colors. What's the market share, desirable market share you would like to have in your top 3 businesses, AMC, insurance and NBFC?
I would say 10% and above. I think we are currently, our market share in life insurance, for instance, has grown from about 5.3% to about 9% over the last 2 years. In mutual funds, we've grown from again about 5% to about 8.5% market share. So I think we are growing faster than the market. Our intent and our objective is to continue to do that. If we do that, as I say, I think the 10% number is not far away. And I think that the market share as such is not the real driver of break even.
But how crucial is market share and how crucial is growth?
I don't think you should go after them for the sake of a number itself. My view is that you have to look at opportunities in the market and capitalize the assets and resources you have in the best way possible. So I would say I'm a big believer in balanced growth in any format, whether you're in a bullish market or in a market that's not looking as good. I think you always have the opportunity in the economy in which we are working to find balanced growth, to find growth that is profitable, to find growth that can give you above average market growth and still give you profitable business.
So if given an option to pick and choose perhaps, and this could be a odd googly, let's say to be a number 4 player in large businesses and be profitable. So if you have to pick and choose option A or option B, tick mark the one you'll choose.
No, but I don't know why you have to make a choice, because as I say, we are in a position where you can still be a large player and you can still be profitable. If I can be much more profitable in every term by being a smaller player, then I think that becomes a call you have to take. But I don't think we're in the position where we have to make that call, because I think you can still see growth, still build leadership and still have good profitability. And we define leadership as being not just a numeric measure of sales or new business premium or assets under management. Leadership for us is a multifaceted feature, and it has to include the profitability of the business, the quality of the business we're writing, the quality of customer service we're providing, quality of support we're providing to our distributors. It must have that multifaceted approach.
Since insurance AMC businesses, they don't have large tangible assets, it's difficult to understand the embedded value. Crystallize that for us, not for your company but for the industry per se. How does one understand the embedded value in some of them?
See, the embedded value in a life insurance company is basically the value of the business you've already written. So it's the business you put on your book already. What is the future value of that stream of business? That's the embedded value. And then the second component of a value of an insurance company is the value of the future business you'll write. That is why people look at the value of new business, because then the growth of the business and the value of the new business you put on tell you what the future growth of the business is likely to be. And the sum total of the two basically gives you the total value of a life insurance company.
Okay. I'm just going to gently guide the conversation away to now what's the industry character is. The industry character is that it is ULIP versus SIP, it is SIP against ULIP. And since you're selling both and you cannot take sides, what's your frank opinion?
See, I think the propositions are quite different, Nikunj. I think my view is that the ULIP proposition is very much an investment come protection proposition. The mutual fund proposition is very much an investment proposition. And I think in terms of timelines, if you're looking at, typically people have a slightly longer timeline when they're looking at a ULIP, because it has protection and it has investment over a long period of time. And therefore it typically has to have a longer term viewpoint to it. So I think the propositions are different, and therefore I don't see a conflict at all.
Now your first large, and if I say for the group per se, was you acquired a brokerage business. Uh, do you think there are still enough options where you would like to explore inorganic growth, or organically you're confident of growing at your hurdle rates?
See, I look at that question in two parts, because the first thing is in many businesses, building a platform is often done well through an acquisition, and we saw that in the retail broking space. The ability to get a platform of brokerage licenses, to get a customer group, to get a branch network is all very good when you're looking to build a base in a business that you don't have. I think once you have the base across most of the verticals that we discussed, I think then you have to look at acquisitions a little more opportunistically, and there you have to look at acquisitions that either meet a strategic gap that you're looking to fill. So maybe there's a product gap that I cannot fill organically, and I need to look at an inorganic option, or there's a distribution opportunity that you look at. So we would look at them through two filters. One is strategically, how does this fit with what we're looking at? And financially, does it really make sense to a build versus a buy decision? But we are always open to that call. I think we're always open to look at opportunities to acquire.
But organically, what's the hurdle rate you think you would be able to maintain for the business per se in terms of growth?
See, I think hurdle rates are typically only when you find capital is a scarcity, then only you're going to ask that question. As I said, I think in our insurance business, our shareholders are very supportive and willing to fund the growth of the businesses. Our other businesses are generating cash enough to be able to sustain their growth. So for our current plans and the current way we're looking at it, I don't think we're going to find that a constraint.
The industry dynamics for smaller insurance companies will change now?
I think across financial services, I think scale is definitely an important element, especially in a market like ours, given the need to build reach across the country, given the cost of acquisition of customers that you discussed. So I think people who don't have that scale, whether in insurance or in mutual funds or in distribution, are going to have to ask that question to themselves, whether they see the ability to scale up in some other form, or they see an opportunity in being a niche player, or they see the third option in terms of having to make a call of exit.
But are we there yet where consolidation has already started? It will just strengthen the industry further?
I don't think we're there yet. I think most people would see many years more of growth, so they may not want to be in a position to take that call yet. But I definitely see, if you ask me 3 to 5 years out, I definitely see you will see those opportunities.
Which large financial service vertical, and let's say the businesses which you manage, which you oversee, you think industry dynamics will change rapidly, and they have to change rapidly for the industry to grow?
I think all of them have some element of that. I think if you look at the life insurance business, I think clearly traditional products will have to start becoming a larger part of the portfolio. I think the unit-linked market has been a strong market. Markets have been good. Distribution has been built on the back of that. Good products have come on the back of that. But I think you're going to see an increased element of protection in the life insurance business. I think in the mutual fund business, we already talked about the change in dynamics in distribution. In the whole distribution business, I think it has to reinvent itself and really look around how you build a franchise around financial planning and customer service. I think the NBFC business is going to be an interesting business because the sources of funding are fairly limited and still tend to be reasonably short-term financing. So how do you broad-base the source of funding, because then that allows the NBFC to do many more things. So I think there are nuances in all of them.
I was hoping if you could share a number with us, and I'd like to take the clock back to, let's say, October 2008, November 2008, when the world was readjusting to risk. This is November 2009. What is the change which you've experienced within the financial service basket in terms of customer approach, in terms of product selling, in terms of product innovation?
In terms of retail penetration, in fact, we've seen continued growth in retail growth right through the period. I think that's the benefit of having the branch network and the kind of all India presence that we have. We've seen the retail customer continuing to look at opportunities to invest their money and to improve their financial future. I think the high net worth customer is probably the customer who was a little bit more wary, because when the correction came, I think the high net worth customer was a little bit more risk averse at that point in time, and I think we're slowly starting to see that changing today.
It's often discussed and debated that there's plenty of money on the sidelines and money will buy this market on every decline. Are we there yet, where HNIs have just started testing waters again? They've just dipped their toes and ready to gauge the temperature of the water?
I think that's true. I think that's true for retail investors. I think that's true for HNIs. I think if you look at domestic fund flows, I think one of the biggest areas of fund flows is probably going to be domestic insurance companies. Now, my guess is there's probably around $10 billion of equity.
How much do you think you'll be able to invest this year via ULIP collections and via other collections in the equity markets?
See, about 50% of our total assets is equity. We currently have assets under management of over 13,000 crores. So I think if you look at the industry as a whole, we expect about $10 billion more of equity likely to be invested by the domestic life insurance industry in the market. So that's a fairly sizable chunk. Mutual fund industry could be about $1.5 billion, $2 billion from the mutual fund industry. And then you have the FIIs who have probably already invested 90% of what they took out last year. So if you look at flows from institutions, and I think the incremental flows we are seeing from retail, there's a fairly significant amount of money that's on the sidelines.
I also really wanted to understand the way how earnings have been so far on an aggregate basis. They do look impressive, they do look interesting, but there are chinks in the armor which have surfaced up now. Without getting into specifics, are you confident that in corporate India will deliver, they will continue to surprise us?
I think what you've seen in the last quarterly results has really been a lot of belt tightening in corporate India, which has led to reasonable growth in profit. So I think a lot of it has come from readjusting cost lines more than the top line. I think the next phase has to come with the more sustainable growth is going to come from top line growth. I think the next quarter's results should be fairly good, and I think you will see earnings upgrades because I think the last quarter comparisons will obviously come through. So I'm reasonably confident on earnings, and I think earnings are likely to more surprise on the upside than anything else.
The famous word which global economist had coined in beginning of 2007, the word decoupling. Now the experience has been, it has worked in 2009, it has not worked in the year 2008. 2010, how important will be the word decoupling?
I think decoupling works at different levels. You're talking about decoupling of economies, you're talking of decoupling of flows, decoupling of markets. I think the world is a very integrated place. So really to get any meaningful decoupling becomes quite difficult.
But if there's a large global correction, if there's a large global readjustment, can Indian markets skirt it out?
I don't think so. I think they might be slightly less affected by by a correction in the West, but I don't think you'll be completely immune from that.
Bull markets, the rules don't change. It's really the courses remain the same and horses change. But whenever this market really regroups itself, and if you're going towards a new high, to your mind, will the leadership in the market change?
In terms of companies and
in
sectors?
terms of sectors, in terms of the variables?
I think it's tended to do that, and you've been in the markets for a while. You see every bull run brings up a few new companies, few new sectors, and I think you'll continue to discover that in the next bull run as well.
I'd also like to take the clock back to not to your current role, but the role which you played in your previous avatar, really managing money during in different geographies. Rate the India story for us. Rate the India story for us. That is this the earning driven story? Is India more like a bottom up story? Is India more like a thematic story you cannot ignore?
See, I think India has several benefits that are quite unique from an Asian perspective, which is the perspective I had. I think one, there's a large domestic consumption story over here, which isn't common across many other Asian markets, which tend to be more export driven. Here you have a large domestic driven story. Added to that, now you have a huge infrastructure story. Many of the other markets are developed already, so infrastructure is not as big a story as this story. And then when you look at the market, you have a really wide range of companies. I think it's very rare to find the range of companies that you find in India in many of the other markets that I've been. And coupled with all of that, I think you get Indian companies with reasonably high returns on equity and returns on capital compared to many other markets in the world. So I think that's the reason why I think India as a whole looks very unique, and I've always been bullish about it.
Easiest way to make money, can I say, it's to buy any of your products?
There's no easy way to make money, I would say, but I think a good way to make money is to look at our products and to build a portfolio around that.
Alright, now before we wrap, I know you hate to talk short-term market view, but you have a short-term market view. Let's hear that out.
I don't know what your definition of short-term is, Nikunj, but it varies. In our brokerage business, we have people trading every day, trading every hour, so that's a short-term view. In other markets, it's slightly longer. But I think from an Indian market perspective, I'm reasonably bullish on the equity markets. I think I look at valuations in a reasonably attractive range where they are currently. I think we're talking probably 13 to 15 times earnings for 2011, which is pretty much in the range at which markets have been. I think liquidity continues to look reasonably good, both domestically and internationally. I think India is reasonably under-owned internationally, and I think therefore will continue to attract more money coming in. And I think the sentiment has definitely changed. So when you've got good earnings, as we've seen, good corporate earnings, when you've got good liquidity to back that, and sentiment is good, I think you should continue to see the market doing well.
Rajat, good to have you on Etnow. Thank you for joining us.
Thank you.
Pleasure to have you.